Ever wondered what mechanical trading strategies are? Well, prepare to unravel the mystery today. Mechanical trading strategies are essentially automated trading methods that use preset criteria or triggers. The goal? To eliminate human emotions from the trading decision-making process. Imagine a world where trading decisions such as when to buy, sell, realize a profit, or accept a loss are not taxing or emotionally driven. That's the world mechanical trading strategies create. The rules are preset, coded into a trading algorithm, and voila, the trades are executed, devoid of emotional interference. Mechanical trading strategies come in various forms. They could be as simple as automatically transferring a specified dollar amount into a 401k account each month, or as complex as strategies based on valuation markers like price-to-earnings ratio, or technical indicators such as moving averages, RSI, MACD, stochastic, and more. Regardless of the complexity, the essence remains the same, minimizing the effects of emotions in trading. Now, let's talk about the benefits of mechanical trading systems. They are automation, consistency, time-saving, probability thinking, exploiting the law of large numbers, and creativity. But wait, what about discretionary trading strategies? Well, these are decision-based trading methods. Here, the trader makes decisions based on current market conditions and available information. The trader's personality and feelings about the market play a significant role. This method is what most traders practice. Discretionary traders, while using their discretion, still follow a trading plan with clear trading rules. However, they have the liberty to bend these rules when conditions shift. For instance, they could adjust their profit targets and stop loss during periods of high volatility, and reduce these parameters or even halt trading when there is low volatility. However, discretionary trading does have its pitfalls. Many traders often second-guess themselves and struggle with deciding when to trade and when not to. The discretionary approach is by nature susceptible to the trader's psychology. No matter how profitable a strategy is, emotions like greed or fear can quickly derail its profitability. In conclusion, mechanical trading strategies offer a method to remove the emotional element from trading decisions, providing consistency and automation. On the other hand, discretionary trading strategies allow for flexibility and adaptability to changing market conditions, but require a high degree of emotional control and discipline. Both have their merits and demerits, and ultimately, the choice depends on the individual trader's personality and trading style. And there you have it, a comprehensive look into mechanical trading strategies and how they work. Whether you're a seasoned trader or just starting, understanding these strategies can help you navigate the ever-changing world of trading.